as long as this bullish trend remains intact, I would just keep buying these dips through the end of the year. Now, at some point, you're going to get a bigger correction. A test of the 50-day moving average is not out of the question. Even a test of the 20-day, 200-day moving average is certainly not out of the question either. But, I just don't really kind of see that happening over the next couple of months.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of the week for another weekly market recap featuring my good friend, the mothballed portfolio manager, Lance Roberts. Lance, how you doing?
Fine. Yes. I've got moss in my closet.
I was trying to think of a good word for shutdown because we
Yep.
hit news this week is the government shutdown. So mothballed was the best I could do on short notice.
I like it. I like it.
Um,
Yeah, we have nothing to talk about because we have no data to work with.
Yeah, yeah, I know the jobs data was supposed to come out today, and everybody was sort of worried about what if we don't get it. It's kind of like, yeah, what if we don't get that data that nobody really believes anyways, and is going to get revised after they tell it to us?
Well, that's kind of the comment we made on our show. I was on our show on Thursday. I was talking with Michael Leibowitz, and then that was the conversation. Is talking about, oh my gosh, this government shutdown. Now we won't get CPI data and employment data, and I'm like, who cares? Nobody really believes that data anyway. You get the data, and then you revise it all, but that's the logical side of us. But in reality, the market clings to that data only from the standpoint of what does that mean for the Fed? Will they cut rates or not? Right. And this whole last couple of years, really since October of 2022, when we hit that bottom, this whole market rally's been based on will the Fed cut rates? How much are they going to cut rates? And we just drift from one employment report to the next CPI report to the next employment report to determine if we should pay more for stocks. It's just ridiculous, but here's where we are.
Here's where we are. Um, well, look, I have this question to ask you later. I may as well ask it now.
Yeah.
What impact, if any, do you expect it to have market-wise?
None. We actually did a study this week in our daily market commentary, looking back at past government shutdowns, and the market's up 85% of the time. Yields typically fall during shutdowns. It has very negligible impact on markets at all. I mean, it may give them a little bit of wiggle, but it doesn't have any real impact because at the end of the day, and again, when you look at the markets where we are right now, people are just chasing momentum at the moment. It really has nothing to do with the economic data or even the fundamental data. I mean, we've got stocks trading at 40 times valuations. Nobody cares about that. That's just a function of sentiment. So, again, it's interesting to watch the media get all breathless over the, I'm like, oh my gosh, it's a government shutdown. What does that mean? But let me clear up a few things here real quick. Okay, let's talk about what a government shutdown does mean and what it doesn't mean. Because every time we have a government shutdown, there's always the media headlines. We're going to default on our debt. Senior citizens aren't going to get their paychecks. Military won't get paid. That's all hogwash. In a shutdown, anything mandatory in the budget is paid. That is paid regardless of whether the government is in shutdown or not. If you were involved in any type of protection of property, personal safety, national security, your job is secure. You keep working. The only people that are furloughed are what's called non-essential workers. And these are people that fall outside those categories, primarily in things like parks and recreation, government employees related to the BLS, the Bureau of Economic Analysis. Those employees get to go home on a paid vacation, mind you. They are furloughed. They don't get paid while they're laid off. But as soon as they come back, they get fully reimbursed for all of their time. So the interest on the debt gets paid. We will not default on our debt. Social Security checks will go out on time. Social Security recipients will get their checks. Military veterans and military benefits will all be paid on time. Because why? That is in the mandatory spending category of the budget. Only 25% of the budget is discretionary, and that's the only amount of money that's affected by a shutdown. So that's just the basics of it.
What might be somewhat different this time, I haven't followed the news enough to really know this, but
Yeah.
just reading some of the headlines, uh, as I understand from the headlines, which may be an imperfect understanding, is that during a shutdown, the president has more authority to fire people, at least
Mhm.
in the executive branch. And so this may actually end up being an opportunity for the administration to make deeper cuts than they were able to make before.
That is
Um,
that is
that,
correct.
that is
But
correct.
only, but right, but only if those people are not involved in personal security, protection of property, or national security.
Okay. But
So
a phrase I've heard getting kicked around is sort of like, yeah, the non-essential workers have to go home. Why do we have non-essential workers in the government? Shouldn't you, if you're in the government, shouldn't it be an essential role? Maybe we should get rid of a lot of these non-essential roles.
I've been saying that for years. If I have if I had employees in my business, right, that I looked at and said, yeah, I can live with them, I can live without them. I'm going to live without them. I mean, if you're classified as, look, it's a little different in government. I get it, right?
But I think that's what's different this time is
Yeah,
you finally have a government administration saying, yeah, we don't want them around.
yeah.
People can
And
argue in the comments whether that's good or that's bad, but that what might be different this time.
yeah. No, there is potentially the case that going back to what I said earlier, right? And we're talking about normal government shutdowns. So we've had a plethora of government shutdowns throughout history. The last government shutdown we had lasted a total of 34 days. It was in 2018. That was the longest one we've had on record. Most government shutdowns don't last very long. But shutdowns have been going on since the 70s. So this isn't a new thing that just cropped up. It's like the whole debt ceiling limit thing that we raise every year. That's been going on forever, right?
It's
So
just another tool of brinksmanship that's in the arsenal, the political
exactly.
arsenal. Yeah.
So nobody should get, nobody should be, shocked by, oh, it's a government shutdown, it's a terrible thing. It happens all the time. But, yeah, nor in a normal government shutdown, you furlough off the non-essential workers. That's about 900,000 workers. And then, like I said, they come back. Now, the question will be, and again, this is kind of the debate in the headlines, is will this administration use this opportunity to fire a bunch of government workers and then not bring them back? We'll see if he's successful in that. And let's just say, and look, I don't know that answer, right? I don't know if that's true or not. That's again, like you, that's what they're talking about in the media headlines. But we've seen this government try to fire other departments before, and immediately they file lawsuits, and then one of the circuit federal judges then, bans them from firing that employee for the time being. Firing a government employee is extremely difficult. They have all kinds of protections built into place, and it's very, very difficult. And I'm not saying that's a good thing, by the way. The government should be able to fire employees just like any business, but we've entrenched them into the system over the decades, and now it's very, very hard to fire, government workers from their
Yeah,
job,
I
whether
think
they're
there's a
doing a good
similar
job or not.
analogy in the education system with
Yeah.
tenured teachers. Yeah.
Exactly. And it doesn't matter whether they're doing a good job or not. It's just very hard to get rid of them. And again, we've seen this just recently. I mean, we've tried to shut down Doge, right? Doge
Hmm.
tried to shut down departments, fire, and then immediately they file lawsuits. And then, a judge says, you know, nope, send them back to work. And then you're stuck with this. So, again, we'll see what happens. The one thing I would pay attention to is that it is going to cause an uptick in the unemployment rate. But that's going to be a temporary issue because as soon as these people come back to work, the unemployment rate will reverse. Um, but the conversation that Mike and I had was is this is also a really good opportunity to start looking at alternative data in terms of employment. Paychex just came out. They
Right.
they are a company that surveys mostly small businesses. They showed a negative job creation in small businesses in the last month. ADP just showed a loss of, don't quote me, I think it was negative 32,000.
Yeah. But
And
it was
look,
negative. Yep, I saw that.
yeah, negative 32,000. So now again, ADP, as an example, has not had a very high correlation to the Bureau of Labor Statistics report over the last few years. They used to be much more highly correlated. I used to have a mathematical calculation that I could almost tell you to the hundreds of what the BLS report would be off of the ADP report, but that correlation broke about 4 years ago.
Mhm.
However, once you factor in the revisions from BLS, all these job revisions we get every month, it actually correlates a lot better with ADP at that point. So what ADP is telling us is very likely what we would have seen in the employment report anyway on Friday is a fairly weak number.
Yeah, and
So
you and I
yeah,
have
we'll
sort of
see.
ranted about this before, which is sure, maybe 40 years ago you had to impute a lot of this stuff,
Mhm.
but now in the digital era, we can know all the data, right? I
Right.
mean, we can have these real-time, highly comprehensive reports, yet we still kind of rely on these older imputations, birth death models, stuff like that. Why don't we just look at the millions of paychecks that are going out, to your
Hey,
point?
I've been arguing that for a while. And the other thing too is that, a lot of the government surveys still work on surveys. Like I send Adam a survey or I call him on the phone and say, Adam, what are you doing? And if you take a look at the survey responses, they're just falling off a
They've
cliff.
been going
Nobody's
down, yeah.
responding to these anymore because there's so much other data out there, and there's like pff, whatever. But that lack of survey responses requires more imputation in terms of trying to gauge what the global economy is, and so that's why we're getting all these really weird deviations and
Higher
numbers
error
that we
rates,
shouldn't have.
right?
Yeah, yeah,
Yeah. Well,
yeah.
you've got lower sample sizes, imperfect data collection. Yeah, your
Mhm.
error rate's going to go up. Also, too, look, I don't want to. I want to be a little sensitive to the BLS. They had a massive, um, nuclear shock to their data set during COVID, right? Where
Yep.
just millions of people got fired, and then they scrambled to rehire them. So there is sort of a bullwhip effect
Yep.
that made it really hard for a couple of years. But man, by now we should have more exactitude.
Well, and again, my whole point has been like, for instance, the birth death adjustment is terribly flawed. It's just an estimate that they say, oh, we know this, businesses were created, and every time they create a business, they hire somebody, and that's a terribly flawed assumption. First of all, we know that business formation has not been as strong as what the BLS has claimed. And I've argued for years that if you would just use a 12-month average of your monthly numbers, it gives you a much better reality of what's happening seasonally, right? The 12-month average of your employment set smooths out the seasonality. So all these
Right.
seasonal, you don't need these seasonal adjustments. You don't need the birth death model. If you just look at the actual, household survey of employment and then use a 12-month moving average, you get a much better measure of employment over time. But see, that's too simple. You could do that with one person and a pencil. You wouldn't need a whole
Exactly.
department. So
Too much of a threat to the government bureaucracy. Exactly. All right. Well, look, but key thing investing wise, you don't think it's going to really matter much.
no.
Historically, it hasn't, and I've seen similar data. But just looking at the market don't care, right?
It really
Market was
it
up on
really
the news.
doesn't. Yeah, and again, you have to remember, if this government shutdown happened and we were in a non-favorable market, this would probably, kind of say the market was already weakening for some other reason, bad earnings, whatever it was, and then the shutdown happens, then that kind of accelerates the potentially the selling pressure that comes in the markets. But when you're in a bullish trend, it really doesn't have much of an impact. In fact, I've actually just posted a chart on this morning. If you give me 1 second, maybe I can find it real fast here. But yeah, there was a really good chart out this morning. Yeah, here it is. So this is just a history of government shutdowns. And kind of like recessions, we used to have recessions a lot more often than we have today. We used to have a lot more shutdowns back in the 70s and 80s. But you can see that most of the time when you have a shutdown, the market just kind of keeps on going. And again, like you had a shutdown as an example in 2018, and that lasted 34 days. But during that shutdown, during that 34 days, the market declined, but it really wasn't because of the shutdown. It was because of other stuff that was happening in the markets as well. So, and again, it was just a minor pullback. It wasn't anything major. So, it kind of depends on where you are in the cycle when that shutdown occurs. But for the most part, particularly since 1990s forward, they really haven't meant a whole lot.
Okay. So I want to, in a second, I want to get to kind of the real confusing cross currents that are going on
Mhm.
right now for investors,
Sure.
where you'll see things like if you look at GDP now, the Atlanta Fed's GDP now, I think they're projecting a 3.9% GDP growth rate for Q3, right?
Yep.
Really strong, right? But then you
Mhm.
look at the ADP data and you're like, oh my gosh, like jobs are contracting right now. The jobs market's getting a lot weaker, right? So, but markets are at all-time highs, right?
Right.
So there's just a lot of kind of anybody can find the data they want to make any argument they want because there's lots of data on both sides of the ledger right now.
Sure.
So I want to ask you about that in a minute, but a couple quick things. One here, I just want to note that we're at the beginning of a quarter here, and there are things that come along with that, like companies have, start reporting earnings. So the buyback window will shut for a while, so that'll be of interest. Um, but I do this in my family, Lance, and it's a legacy from growing up. Um, do you guys have the custom of like the first thing you're supposed to say when you wake up on the first day of the month is rabbit, rabbit? Have you ever heard that?
I've never heard that. But I'm
Yeah.
from Texas. We say squirrel, squirrel.
Yeah, or armadillo, armadillo, or whatever, right? Yeah, it's probably a New England thing where I grew up, and I think it's probably from England or Europe. I've heard some people say white rabbit, white rabbit.
Mhm.
But it's just one of these things like don't step on a crack, it'll bring you bad luck or whatever, right?
Okay.
But anyways, so first of the month, first of the quarter, make sure sometime today you say rabbit, rabbit, just to get that good luck mojo going for you. Secondly, folks, given all the uncertainty that's out there right now, I just want to remind everybody that the Thoughtful Money Fall Online Conference is coming up. I'll give more details about it at the end of this, but I just want to remind you, if you haven't bought your ticket yet, you only have a couple days left to get it at the early bird price discount that we've been offering. I've really extended the offer this time because I want as many people as possible to pay the lowest price for this conference as possible. So to go pick up your ticket now, go to thoughtfulmoney.com/conference. And a reminder, if you're a premium subscriber to our Substack, look for the code I've sent you. That'll let you get an additional $50 off of that price. All right, so Lance, well, I want to get to what I just mentioned there about all the different data, but real quick before we do, let's just talk about the market. Maybe you can pull up the TA and whatnot, but we are back at all-time highs. And my question for you is it time to raise your end of the year target? I know you resisted doing it. I know you don't like to, but the market seems to have so much momentum behind it at this point in time. We're already getting a lot of discussion in the financial media about the big round 7,000 S&P number. Is the tractor beam now engaged on the S&P to pull
Oh
it
yeah,
up
for sure.
7,000?
For sure. Yeah. I mean, markets love that big round number. But no, I never raised my target. This is one of my big beefs with Wall Street, is that if you take a look at earnings estimates as an example, they come out, like for instance, we got in March of this year, we got the 2026 estimates all the way through the end of 2026. And so they go, we're going to have, $294 a share in earnings. And then already now it's already down to 274. So what's the value of a target if you're constantly revising your target? And then, yeah, because at the end of the day, if I keep revising my targets, like, see, I was right. Earnings were 255. Well, yeah, but you started at 294. That's not helpful, right? So yeah, no, I never raised, we set our targets out at the beginning of the year. We live and die by them, and that's it. Now we don't manage for targets. It's kind of a fun exercise based on valuation metrics and those type of things, but it means nothing at the end of the day to have a price target. So, great. The market's at 6,700 or 6,800. We're managing the markets where our portfolios are very long equities right now. We're participating with the markets, and that's going to continue. So I'm hoping, yes, I'm absolutely hoping that the markets can gravitate up towards 7,000. There's certainly some reasons for that. Corporate buybacks will start at the end of October. You've got professional managers way behind on performance this year, and you've got a lot of retail momentum. And then also, just as we get into the end of the year, you're going to have portfolio rebalancing for the end of the year, where a lot of these stocks that have been rallying are going to have to get added to a lot of portfolios. So there's a lot of drag now for the markets between now and the end of the year. Now, it doesn't mean it has to happen for sure, and it doesn't mean it's not going to have some wiggles along the way. Generally, the first 2 weeks of December, you get a correction in the markets because mutual funds have to make their annual distributions. You typically get some weakness in early November. And October tends to be a little bit sloppy. You have higher volatility in October. So, but if you have a weak October, now, and I'm about to tell you something else. If we do have some weakness in October, that sets up November to be a very strong month. We've had 5 straight months in a row of the market rising. That's a fairly long stretch without having a corrective month. Now, a corrective month only means that if the month is down 0.01%, that was a corrective month. It doesn't mean a 5 or 10% correction.
Yeah.
But historically, when you have 5, 6 months in a row of advances, you're going to have a down month. So again, we've got some things. We've had a very strong market here. The trend is very positive, lots of momentum. There's certainly some risk here. I would certainly suggest managing risk. We've talked about the new thematic models that we launched recently. I've got a stock in there that I bought on August the 1st. It's up 350% now. So, it's just a lot of this momentum is just, I mean, in these portfolios, I've got a couple portfolios up like almost 20% in a month. So, it's just this whole momentum chase in the market is running, and there's really nothing to stop that at the moment unless something comes along to dramatically change that. And I don't know what that would be at the moment.
Okay. And as we talked about last week, some on this program recently, like Mark Newton, have made the argument, mostly from a technical perspective, that a 5 to 10% correction in October, November wouldn't be out of the question, certainly could be justified. In Mark's case, and I think in yours, Lance, too, I think you're saying this right now, that would probably be a buying opportunity to then try to catch the end of the year rally.
Absolutely. Yeah, no, you buy any dip between now and the end of the year. So yeah, I mean, I would not expect anything substantial here. This market has consistently been buying the 20-day moving average. If you kind of look back just over the last, really kind of since the April lows, and again, it's so funny. You had this 20% correction in April, and nobody, you'll remember this. We were on this, we were talking about this then. Everybody was panicking during this 20% decline. And it was like, oh my gosh, the AI is dead. Nobody wants to own AI stocks anymore. All the thesis is wrong. The whole 9 yards. And it was like, oh, this is the big one, Elizabeth. And then of course, that was the bottom on April. And by the way, that was a
Sanford and Son reference. I got it.
I was going to say you would get it. Most of your listeners probably are like, "Who's Elizabeth?" Anyway,
Oh, I think we got a bunch of Red Fox viewers here.
Yeah, you could not have Red Fox on TV anymore. That's for sure. But anyway, so after that April low, this market has just been consistently challenging the 20-day moving average. And every time we get to the 20-day moving average, that's been your kind of buying opportunity. And they've been very swift. Every time that we've had these little dips back down here, the investors have stepped in, bought these dips repeatedly. They just bought this one, 5 days ago. So again, I would just, as long as this bullish trend remains intact, I would just keep buying these dips through the end of the year. Now, at some point, you're going to get a bigger correction. A test of the 50-day moving average is not out of the question. Even a test of the 200-day moving average is certainly not out of the question either. But I just don't really kind of see that happening over the next couple of months unless somebody comes out over earnings. And so what you need to have a correction to 200-day moving average is, say, NVIDIA comes out, and that'll be in November, and they come out and say, yeah, all of our targets were wrong. We're cutting our revenue estimate. We're cutting our investment, Capex projections. That would cause this market to sell off sharply. I don't see that. I'm not saying that's going to happen. I don't see it happening, but it would take something like that to reverse the momentum of the market.
Okay. All right. So here's where I'm going with all this. So I talked about these, data points on either side of the ledger here. I just released a really interesting video with Michael Kantrowitz of Piper Sandler. He is the Hope Framework guy.
Yep.
And what I like about the Hope Framework is it's a very empirical way of looking at the world. And so it's sort of one of those, like, he may have all sorts of personal opinions, but if the framework isn't validating the opinions, he relies on the framework.
Right.
And one of the things that he's looking at is, I asked him, in a nutshell, how would you describe the current environment? And he said, I think we're entering a Goldilocks backdrop for the economy. And what's interesting about that is, Lance, you and I have talked a lot about how there's lots of data that we're seeing slowing economy. But, there are things like GDP now, like I told you, I mean, 3.9 is higher than what the economy's grown so far this year. And here's what he said. He said, we're seeing some good growth in parts of the economy, and it seems to be broadening out, right? So it was kind of the big tech, all the infrastructure investment in big tech driving the action, but now we're starting to see some of these unloved sectors see some return of capital in there. The profits are beginning to recover a bit. Lower inflation, right? So, again, inflation hasn't gone away, but it is definitely a heck of a lot lower than it was 2 years ago, right? And there are signs that it's continuing to moderate. And I know you're on that team, Lance, that we're gonna disinflate from here. He expects lower interest rates going forward. One, because the Fed is going to be cutting the policy rate. They've already started, right? But what gives him confidence that we're going to continue to see lower rates there, and this is the interesting part, is he says, yes, the jobs market is weakening, but it is weakening at sort of the Goldilocks level. In other words, it's weakening enough that the Fed is changing policy to bring rates down, but it's not, spiking in a sense that like, oh my God, the economy is melting down and tons of people are out of work. So it's weak enough to get the goosing of economic stimulus or monetary stimulus from the Fed, right?
Right.
So and he's got a bunch of charts that show kind of whenever you've had that set of conditions, you get recovery. You get stronger economic growth going forward. And then the other factor he mentioned too was low oil prices. He says, absolutely low oil prices have been helping the situation. The tariffs, or inflation would be biting much more if oil had been a problem here, if we had oil at $80 or $90 a barrel, but we don't. It doesn't look like we're going to have that anytime soon. So kind of where he's going with this is like, I think 2026 is actually probably going to be a better year, economically speaking, economic growth speaking, than now. And I don't see why the markets won't benefit from that. He's not necessarily saying that the markets are going to grow at the same rate they've grown this year or the previous years, but he thinks that there's going to be a lot of recovery in the rest of the market, the smaller cap stocks and really just the S&P 493, who've largely kind of been left behind by the Mag 7. So, I was kind of asking him like, wow, so are you basically saying that like, despite everything that's gone on, despite all the concerns that the valid concerns that many people, myself included, have raised, the market's likely going to have a third double-digit growth year this year. We're going to have avoided recession, and we're looking at a year ahead of us where the economy looks like it could be doing pretty well, and the markets will, look set to have another positive return. And he said, right now that doesn't seem that improbable to me.
Yep, no, he's right. The interesting thing is that is the kind of the mainstream consensus right now by Wall Street in general, is that we're going to have this economic recovery.
Yeah. I mean, it must be because stocks are bulletproof at this point.
Well, yeah, but there's more behind that you have just momentum and sentiment driving markets at the moment. But the interesting case is for Wall Street is based on earnings, and what they're expecting is that there's going to be a sharp pickup in earnings for the 493, and the 7 are going to have slowing earnings growth, and that'll kind of equate itself out, and that's going to give you another 10-15% return year next year. Well, the problem I have with that analysis is only this, is that we've had booming economic growth for the last 3-4 years. Ever since 2022, we've had very strong economic growth because of the Inflation Reduction Act, the CHIPS Act, all that. And the 493 didn't generate any earnings growth to speak of. They grew a little bit, but nothing important. Single-digit growth rates in earnings and revenues. So what makes it different going into next year that all of a sudden this economic activity is going to shift into these 493? Well, there's, that's the question we've got. I'll get an answer now. The hope is that all this AI Capex spending, this kind of 3 trillion-ish that's sitting on the books for 2030, that's going to get spent building data centers. Well, that requires, Caterpillar and Deere to go, build roads and bridges and those type of things, construction companies to go build the facilities, power grid, utility companies to build the power infrastructure, all that. So that's where all this growth is going to come from, because that 3 trillion will translate into basically 12 to 15 trillion of economic activity between now and 2030. That's the hope. That's a lot of hope. Right? I'm not saying that can't happen at all. And I think you should have at least part of your book allocated towards that. And if you take a look at our portfolio, we have allocations in those areas to participate that. So we're looking at that very closely. but the expectations are very elevated for that to occur. And as always the case, it's going to be the disappointment of those expectations that cause the big problem for the markets, regardless of what the economy is doing.
Yeah, and I sort of prodded Michael on that, and he did say, "Hey, look, yeah, if it turns out that everybody wakes up and all of a sudden thinks that we're going to have a lot fewer profits in AI, or at least fewer profits early on, nearer term, um, or that there's just less there in any way, shape, or form, then yeah, then it's so big, the negative wealth effect of the evaporation of that phantom capital, would send shockwaves through everything. So he agrees that could definitely be what spoils the soup here. But it was just interesting because I think that's a hard thing, I'm going to guess, for a number of viewers of this channel to wrap their brains around here, which is like we went through uh, we went through COVID. We did all the distortions of the economy. We, created this massive inflation. Um, uh, we've seen that the economy, employment market has weakened the way many of us suspected it would and whatnot. And yet we might make it through all this without really having to pay the piper.
Yeah.
Right. Now, to be clear, and Michael is one of the, guys who talks about the bifurcated economy and the bifurcated markets more than anybody else. So he gets the whole K-shaped thing. We're talking not having to pay the piper on average, right? Meaning, the top part of the K is doing great. Bottom part's doing increasingly worse. So I don't want to suggest that there aren't people out there who said, hey, I'm paying the price here right now. And certainly from the purchasing power of our currency, it's taken its time. It continues to be, in my opinion, the release valve that does pay the price for all this stuff. It just buys
Well,
well.
that's just inflation, though. And if inflation drops, that improves that condition. And more importantly, if you get stronger economic growth, that's going to be the one byproduct of that will be a much stronger dollar. And so once you start getting improvement in the dollar, remember the dollar is just relative to every other currency. So whether the dollar is going up or down is just relative to other currencies. And that's one of the big headwinds potentially for earnings, which is that multinational companies have benefited greatly from the weaker dollar because of their profit margins. Because again, it makes products for international people. If I live in Europe, I can buy U.S. products much cheaper
More
because
cheaply.
of the currency exchange rate. But the dollar's been basing now for several months and is starting to build a much stronger appetite. And in fact, we just did some research this week. You're starting to see momentum coming back into the dollar. So if we see an upturn in economic growth, which is also what the dollar is potentially laying out, you see an upturn in economic growth, the dollar rallies sharply. That's going to start impairing earnings for multinational companies. So companies like Apple, Nvidia, Google, those type of things, they'll take an impairment on earnings from that stronger dollar. So again, when we start talking about earnings reports, those type of things, any asset that trades in dollars potentially gets impacted as well. So again, one of the big trades for next year you want to pay attention to is going to be the strengthening of the U.S. dollar.
Okay. And I'm curious, do you think that's more likely than not that the dollar?
Oh, that's probably about a 90% trade next year.
Okay.
In the next 12 to 18 months, you'll see a stronger dollar.
Okay. And I'm glad you mentioned that. And I asked you specifically just because I've had some folks on recently who think that the dollar is going to continue to be in a bear market. So I'm beginning to note this as one of the topics, kind of like how inflation has been for the past year and a half, where I'm seeing more difference than consensus.
Well, yeah. You've got what you've got is you've got a big consensus trade on short dollar, and that's the one thing I love about consensus trades is that when everybody gets on one side of the trade, no matter what it is, whether it's stocks, commodities, the dollar, interest rates, inflation, everybody was super, high. Inflation's going to the moon, and that's why we were saying it's like that's not going to happen because of all these other reasons, and then inflation's been coming down. Consensus trades are great for contrarian bets, and you've got a massive short position against the US dollar right now. And again, that makes complete sense because if I'm a hedge fund and I can short the dollar and make money with it, I'm going to keep shorting it as long as I'm making money with it. The problem comes if I get a reversal in the dollar, I have to start chasing the dollar higher to cover my shorts, and that fuels the dollar run. So that's why, when you have a big consensus and a big short position against a particular asset class, it's a really, really good technical setup for a bull rally in that particular asset.
Okay. And I just want to note to our viewers who have really been enjoying the returns in their precious metals that there is a general inverse correlation between the dollar and gold, and that's likely been one of the tailwinds behind gold,
Mhm.
that the dollar has been weakening, over the past
Yeah.
year. Um, that correlation doesn't always hold. It's not like a law of nature, but it's a more often than not. So if Lance is correct and the dollar strengthens from here, just be prepared of the possibility that that may actually be negative for gold.
Yeah. I mean, and that's just a function of, again, if I own gold in a foreign currency, right, and the dollar rallies, then I'm not only getting impaired on the dollar rally, the differential in the currency, I'm also getting impaired on the asset. So people will sell their gold to move it into US treasuries as an example, which would benefit from a stronger dollar.
Right.
So,
And another thing, I didn't talk about it with Michael as much as I wish I had, but uh, a question I've raised to you and others of late is, if the administration is successful, if it's the economic policies that it's been aggressively pursuing are successful, they take a while to take effect and to start being reflected in the real economy. But we're now what, 9 months into the new administration.
mhm,
At some point, Q2 next year, Q3, whatever, if those policies bear the fruit that the administration hopes they will, that's going to start adding tailwinds to the economy as well, right? So in
right,
addition to the factors that Michael laid out for us there may be the additional boost of, okay, we're finally starting to see what the administration was hoping we were going to see from all the things that it's been doing, the
right.
deregulation, the tax relief, the new trade deals, stuff like that.
Yeah, and one thing too is just, we're talking about stronger economic growth. We're not talking about 6% economic growth, right? I mean, we're talking maybe 2.5% economic growth next year.
Well, okay, I mean
Maybe,
that's a good question.
yeah,
And okay,
yeah,
so is that what you think? You don't think that
yeah. No, I mean, I just don't. I don't want
you don't think
to.
Trump's gunning for 4+?
Yeah, no. Look, we haven't been able to run a 4+ economic growth rate for any length of time at all in this economy, outside of juicing the economy through stimulus checks. But we'll probably run it, again this year once we kind of all tally this up. I know right now the Atlanta Fed's at like 3.9. That number is going to come down a
It's
good
going to
bit.
gyrate. And
Gold,
Q1 was negative, so
yeah, yeah. So Goldman Sachs right now has Q3 pegged at like 2.2%. So you have negative 0.5% in the first quarter, then you've got the 3.8 and 2.2. And when you start adding all that up by the end of the year, we're going to be right around 2% growth, 2.1. And so maybe if we get a little stronger economic growth next year, maybe we're running at 2.5. But again, we're not talking about gangbuster economic growth like we're going to return back to the 60s and 70s, at least not at this juncture, because the debts and the deficits are still going to erode and retard economic growth because it diverts capital into non-productive purposes. So that formula hasn't changed. And you're still in a deflationary environment. So that formula hasn't changed either, which is going to weigh on economic growth. And again, the top 10, 20% of the population can't drive the entire economy to astronomical extremes when you got 50% dragging. And so those dynamics in the economy, demographics, debt, and deficits, those haven't changed. And that's gonna continue to impede economic growth. Doesn't mean we'll have a recession. Again, we'll avoid recession, but we're not going to have this gangbuster, we're not going to have this return to Goldilocks economies that, kind of is the idea, right?
okay. So what I hear you saying here is just, hey, yeah, maybe, but manage your expectations. All
Yeah.
right, this brings me back to my earlier question then. Beginning of this year, you wrote a piece called Curb Your Enthusiasm,
Hmm.
right? Which basically told people to expect a more volatile year ahead, right? It's not going to be the escalator ride that 2023 through 2024 was.
Yeah.
And you were right for the first third of the year.
Yeah.
Uh, it's been an escalator, pretty steep escalators.
Yeah.
So I'm just curious, are the conditions you wrote that piece for now moot? Are we beyond them?
They've that 20% correction certainly removed a lot of the risk out of the market. So the great thing about corrections is they reset the table. And so if you go back and look at sentiment as an example, investor sentiment dropped to levels that we haven't seen since the financial crisis. I mean, you had such negative sentiment in the markets. All that bullish kind of extreme sentiment was completely wrung out of asset classes across the board. And so that reset that table and allowed for this run. I don't think we're done with volatility yet. Again, a 3 to 5% correction between now and the end of the year is not out of the cards at all. So again, by the time we get to year end, we may still see, hey, this is a good year, but again, it was a bumpy ride along the way, which was kind of the idea to start with. Now, next year we'll see what it looks like. But valuations are problematic where they are. And again, we're now trading at the highest valuation based on forward PEs that we've had since the turn of the century. So again, valuations do matter longer term. In the short term, it's just a reflection of sentiment. They don't mean anything. And over a 12-month period, valuations mean zero. All it tells you is everybody's very exuberant about stocks. That's all it tells you. But over the long term, high valuations do matter. And at some point, the expectations are going to have to come to fruition. We can't keep just pushing that bar saying, well, I thought they were going to make, $5 a share. So maybe if they make six, I can pay more for a stock, right? At some point, those companies are going to have to step up and really make those earnings. And I think that's the bigger risk we get into over the next couple of years.
Yeah, well, I'm just like, so let's assume we end the year around 7,000,
Sure.
just for a second, okay? I don't know I know here at 67,000 on the S&P. And by the way, I should have mentioned this earlier, folks. Lance and I are recording this on Thursday. We told you we were going to do that last week. We're also going to record on Thursday next week as well. Although it'll be Mike Leibowitz next week in Lance's stead. We're doing that just because of schedule issues on both the RIA teams and my side. So we don't have Friday's data here yet. So forgive us if the market does something amazing tomorrow and we haven't been commenting on it here. But so right now at 6,700, it's up about 14% year to date. So I'm going to guess 7,000 would be somewhere around 20% for the year, which would be basically three back-to-back years of 20%. Does that make you nervous? I mean, at some point, is it so good you're like, look, this just can't continue like this going forward?
So 20% plus gains happen more often than you can imagine in the markets historically.
I get it, but back to back to back.
Yeah, that it happens, and that's momentum, right? That's just momentum in the market. So again, once you start having that kind of momentum, it's going to continue to drive it until something breaks it. And again, it's all about psychology. So what will happen at some point? And again, I don't know whether it's this year, next year, year after next, 5 years from now, whenever it occurs. But at some point, again, and it was interesting, just this past, few days ago, we had Jerome Powell come out and talk about the stocks are fairly highly valued, which was very reminiscent of Alan Greenspan's irrational exuberance moment back in 1996. Well, the market ran for 4 more years. And the biggest returns of the market came in the last 2 years of that run. Then eventually reality, kind of came to fruition. So at some point, these 20% gains are fine. And the way this math is working is, and again, as I mentioned a second ago, is I look at the S&P and I say, okay, I think the S&P next year is going to earn $274 a share in earnings. And so we get to 274 and the markets are doing okay and it's fine. And so I go, well, I think they could actually make 294 and then I push it to, 315 and then I push it to 380. And so the more the market rises, the more emboldened I get to keep pushing those forward projections. And this is from Wall Street side. And I can do that so that I can justify, well, if I could generate $300 a share in earnings, and all of a sudden my forward PE isn't 22 anymore, it's 20. So now I can run stocks back up some more, back up to 22 times forward earnings. Well, when I get there, I've got to bump that, I got to bump the E again. So at some point, though, that E becomes so unattainable, that's where your problem comes. And right now, that E on forward projections is the highest deviation from the long-term growth trend ever on record going back to 1900.
So let's combine that with the back to back to back nature of this. So you mentioned the late 90s, right? That ended in a big correction, right? So is it sort of I mean, it sounds kind of obvious, but is it the bigger the run up, the bigger the correction when it arrives?
Well, it's interesting. So this weekend's newsletter is talking about the 1996 comparison, and we're just looking at the markets today versus the, kind of the market back in the dot-com era. because there's a lot of similarities going on.
It is. It's
You
funny. I'm
know,
thinking back, like there was exuberance in '96. Like if it was so tiny compared to where it got by the
well,
end.
yeah, and so this isn't 96-ish. We're probably more 97-ish, maybe 98-ish, somewhere around there. But back then you had companies like Global Crossing and Pets.com and others, and there was a lot of revenue, kind of you buy from me, and I'll promise to buy from you, and if I buy from you,
Right.
you'll buy from me, and if you'll give me some internet.
Like Nvidia appears to be doing right now,
Yeah,
but
yeah,
okay.
yeah, yeah. So that's what I'm saying, though. There's a lot of similarities of that, right? There's a huge difference, though. So this is the one thing to think about is that in 1999, when Enron came to fruition and everybody realized the fraud, and it wasn't just Enron. Enron was just he was Enron was the Bernie Madoff of what was going on in the dot-com era, but it was WorldCom, it was Lucent, Gross, Global Crossing, all these companies. They had no revenue, right? And so all this valuation assumption, everything that was going on with those companies completely fell apart because
Well, those
there
guys
was
had
nothing there.
revenue.
And these companies went bankrupt because they had no other revenue. Now, let's fast forward to today. Let's just assume for a moment that tomorrow, Adam, we wake up and this whole AI thing is a complete pipe dream.
Yeah.
And the models are proven to be absolutely, crappy. And we're never going to use it. It was a complete waste of time.
Yeah. Artificial
Extreme.
stupidity. Yeah. The
Yeah, yeah,
narrative flips.
exactly. So we just go with that assumption. So companies like Apple, Meta, Microsoft, Google, Apple, they're going to take big hits, right? But they're not going out of business
Right.
because these companies already had massive businesses without AI.
Yep.
Amazon's going to keep selling product every day without AI.
Right.
Walmart's going to keep selling product every day without AI. Google's going to keep selling ads and YouTube channels, and Meta's going to keep selling, Facebook ads and all that stuff. These companies will go down 30, 40, 50%, but they're not going bankrupt. But what to your point though, and what the point you're trying to make here is that that's the risk, right? Is that we build up so much expectation in the markets, which is what's happening right now, and that's a reflection of valuations. Valuations are just a reflection of expectations. The expectations are becoming so elevated that even the smallest miss at some point, even the smallest disappointment, is going to lead to a more severe repricing in a lot of these stocks that either have very little earnings. Think a company like Oklo, right? There's a big bet that we're going to have this massive push for nuclear energy, and that's why Oklo is running. But Oklo has no revenue. They have no income because they haven't built a plant yet. So there's going to be companies that could eventually, and again, I'm not using Aqua as an example. I'm just, saying this is the case. There are companies that are tied to this AI chase that have no business model yet. They are hoping and they're getting priced on expectations this AI thing is going to matter. There's a lot of other companies that have massive businesses with or without AI. So in your portfolio, you need to be very selective about the companies that you own because if these expectations falter, there's going to be some companies that will go out of business. There's going to be other companies that are deeply impacted but will survive. And there's going to be other companies that will go relatively unscathed because it has such a small, minor impact to their portfolio. Think about Costco or Walmart, right? So make sure your portfolio is diversified and allocated in a manner that you can weather such a downturn.
True. Let me ask you about Costco, just because you brought it
Sure.
up there, though. Costco is trading at really high multiples,
Yeah,
right?
but have you been to
So,
Costco?
no, I know, but let me ask you this.
Yeah,
So,
I'm just teasing.
in your, a meteor hits the AI
Mhm.
sector, right?
Right.
And half the market value of that gets vaporized, right?
Yeah.
Like the whole world is going to turn risk off, right?
Yep.
And
Yes.
so these crazy multiples that, not, relatively crazy for historically, that Costco is trading at will probably get cut pretty darn hard. So I agree, Costco won't go down as much as an Nvidia would in that
Right.
world, but it would not be unscathed. I mean,
I said relatively.
yeah,
Yeah.
yeah.
And what I mean by that, though, yeah, no, I agree with your comment. And again, I'm just pulling stuff off the top of my head.
Yeah, yeah, and
Um,
I'm not saying that Costco won't get. Sure, it'll get hit less, but it's
yeah,
still benefiting from this halo effect of everything's
sure.
awesome and AI is going to change the world, and so let's pay higher multiples for everything. Yeah,
Yeah. Well, no, and again, take a look at Costco example, trades at a price to sales of 1.5. It's not grossly overvalued. There are, and again, its forward multiple is 41 times earnings, and that's pricey for a consumer staple stock. But
That's what I meant.
when you think about Costco, right? And the thing I love about them is that membership.
Yep.
That is just free cash flow every single year that comes into that company. So, that's going to be more of a defensive like a defensive rotation stock. More likely, Walmart will likely be a defensive rotation stock more than say, financials.
Yep. I just want to set the
Yeah.
expectation that yes, you want to get defensive like that, but like in this kind of nuclear event we're talking about, almost everything's going to get
Oh,
hit.
well, look, if we
You
if
might
we
be
get to
glad you're
the
down 20% versus 60, right?
Oh yeah, yeah. No, and look, and if this market, if we get into if we win, I'm just going to go out there and I'll say, look, when we get to that point, we'll have 15% equity in our portfolio. I mean, we won't have a lot of exposure to
Yeah.
stocks in that risk off event. We'll be mostly in treasuries at that point because that's what's going to benefit the most. But that's going to be something down the road for
Yeah.
now. Yeah.
Can we just do a quick check-in on AI? I know we talked about this last week because there was some news. I haven't had a chance to look at it much this week, but I'm just curious if you've seen anything. It seems like almost every week there's another person, you know, at the top of the AI pyramid or at the top of Wall Street who just says, this thing's a bubble.
Oh yeah.
Yeah. And, we're now beginning to see, front page news that's analyzing the round tripping of capital amongst the companies in this ecosystem, Apple investing in OpenAI, that invests in Microsoft, that invests back in NVIDIA stuff. Um, so, I mean, right now the stocks are doing fine, but what's your level of sense of us getting to that? Because what is it? Ben Hunt sort of talks about what happens when private knowledge becomes public knowledge. In the
Mhm.
classic parable of it is the emperor has no clothes.
Right.
Everybody sort of just accepts the emperor is walking around naked until the little kid says, "Hey, that guy's got no clothes on," and then all of a sudden everybody says, "Oh, I guess we can all admit this." So,
Yeah.
do you have a sense that we are heading towards that moment where it's just like, hey, look,
Oh
this
yeah.
this could all be great, but like at the end of the day, where are the incremental revenue, profits coming from this thing? Where are the incremental revenues? Because again, they're selling a
Yeah.
bunch of pickaxes and shovels, no doubt, right?
Yeah.
But if all we end up with out of this is a whole bunch of pickaxes or a bunch of data centers that honestly just make electricity expensive for the rest of us,
Mhm.
and we're not getting gobs of new profitability in return, at least not anytime in the foreseeable future, then that is not sustainable.
Right. No, no. The problem with bubbles is they're only recognizable in hindsight, right? Unfortunately. So the problem is when you're in the midst of a bubble, we can all say that, oh, look, it's a bubble, it's a bubble, it's clearly a bubble. Nobody really knows if it's a bubble or not until we pass the point that it eventually pops. Now, is it fairly safe to say that there's a lot of AI stocks that are in a bubble? Yeah, you can go there. You look at some of the valuations that are getting paid for companies. Those are very bubble-like, kind of categories. But as we saw in 1996, 1997, 98, 99, that inflation of the bubble can last a whole lot longer. And this is the point of this weekend's newsletter that we're going to write is because Michael Symbolist had a great article about AI. And so I've taken some stuff out of that for the newsletter, but talking about some of the stuff that's going on. And then I've got some tactics about how to navigate the inflation of a bubble. But the important thing to understand is that the inflation of the bubble can last a very, very long time. And it doesn't necessarily have to pop either. It can slowly deflate over time. It
Right.
typically doesn't, but it can. So, betting, and this is so, and again, goes back to, our very basic premise that you and I have harped on for the last, 5 years, because, there's all these people coming out, the market's going to crash. This is going to happen. The market's going to go down 50%. You better get out of stocks now. And that hasn't happened. Market just keeps going up. And that's because of sentiment. And this is why we focus so much, when you and I talk, we focus a lot on technicals, we focus on the sentiment of the markets, we focus on conditions, because we focus on money flows, because that's what drives asset prices. And as Peter Lynch once said, more money's been lost trying to avoid the crash than actually
Right.
what you would have lost in the crash. And that's happening to a lot of people right now. They're missing out on the markets. They've missed out on the markets. Now they're trying to get in because of FOMO. That can drive markets higher, but that's also what happens towards the end of a cycle. So, the problem for me, and then look, I don't know the answer, but I'll tell you this is that, as is always the case, you have to have a definitive time frame for these things to occur. Yes, is the market going to have a big correction? Absolutely. Problem is I can't tell you when. So until I can give you an estimate of when that's going to happen, don't worry about it right now, because again, things are working in the markets that are very supportive for the markets. We will eventually have a 30, 40, 50% correction at some point. Again, like we talked about last week, just a correction back to April lows at this point would be almost 30%,
Yeah.
right? And you'd still
Gut
be in a
wrenching,
bull.
and we'd still be in the bull trend.
Yeah,
Yeah.
yeah. It would just be a correction. Everybody be going, it's a bear market. No, it's just a correction in a bull market. That's all it is. Because you went back to trend lines. So again, don't worry about, these things. You need to be aware of these things. And this is the point of the article, the newsletter this weekend. Be aware of these things. Be aware of the risk. Pay attention to earnings growth. Pay attention to what's happening with announcements. Manage your risk in your portfolio. And at some point, these things are going to start to evolve, and we'll be able to identify, hey, the market just put in a major market top. We need to start reducing equity. Um, I'll tell you when we get there, but we're not there now.
Okay. Okay, great. So you went right where I was going to ask you to go, which is, this is a big reason why I recommend so many people consider working with a professional financial advisor.
Mhm.
Because this is, I mean, it's tough in general, right? Nobody knows
Yeah.
what the market's going to do. And as I like to remind people, everybody has their own zone of excellence and what you spend your time on, whether it's your job or your family. And not everybody is a great, super experienced investor who
Yeah.
has the sense of market history that you do. Um, but this, I think, is a particularly confusing market. I think, especially for the type of person who's watching this channel, because these are critically thinking people who have worked hard to make, to generate and save capital, and they want to provide and protect their families, right?
Mhm.
And right now, I think a lot of them feel squeezed between two competing emotions, right? One is this market is stupidly overvalued, and it's ripe for a correction, like you said, right? And
Mhm.
I see the FOMO around me, and I don't want to be the greatest fool who finally capitulates and gets in, and then this whole pig rolls over, and
Right.
I've done the exact wrong thing, right? I missed
Right.
the run up, or I missed a lot of the run up, and I get into the exact wrong time, right? I
Right.
totally get that feeling. But then, we were talking about, Kantrowitz's thesis here, which is like, you know what? This doomsday didn't arrive, and now there's a pool of evidence, maybe even a growing one, that says we might get out of this thing okay, right? We might be entering into a better economy next year. The markets might be broadening, in a way. And by the way, Michael says that, active investing is probably going to be where you get the better returns going forward,
Right.
than just riding the big names. Um, but that side of the argument says, well, look, if you just keep sitting out, you may miss another great year, a couple years in the market, right? I mean, after 2023 put in a 20+% year, there were a ton of people who said that was crazy. And it was coming off the lows of 2022. So, okay, I guess I get it, but that's a one-off event. And then they were surprised by a 20% return in 2024. And now they
Right.
might be surprised by a 15 to 20% year again here in 2025, right?
Yep.
So, they're just missing great gains in the market. So, um, you kind of answered this already, but what would be your direct advice to that viewer right now watching this who's feeling like, yeah, I'm squeezed by those two emotions. I really don't want to miss out on better gains if green shoots are coming, but I don't want to be that stupid last fool.
Yeah. Well, two things. One, this is always one of the biggest challenges of the markets, which is getting into them. And, there is no good way. And look, we have tried every method in the world to onboard clients in a portfolio. So if you come over as a client or a prospect and you say, "Hey, Lance, I want you to invest my money for me." I've tried everything over 35 years of investing. I've tried to dollar cost average into markets. I've tried to pick bottoms in markets to get money invested and all those type of things. Onboarding, getting invested in the markets is the most difficult thing because it's never the right time and nothing ever works the way you expect it to work. So, we have a very simplistic method. We onboard half of our positions right now. Then we look for opportunities to add to the rest of the positions over time. It takes about 12 months, but we get you into the portfolio. It works over time. But it's again, it's never perfect timing. It just never works well. So getting into the market's the most difficult thing. Now, let's just assume today you're sitting 100% into cash. Well, I'll tell you what, let's do one better, Adam. Let's go back to March of this year, because you and I actually had a conversation about a gentleman in this exact situation. So in March of this year, you bring me assets, and I'm going to buy half of our positions, and I'm going to buy all of our bond positions because bonds are going to act as a hedge if the market declines.
Yep.
And so absolutely, you're invested. Market declines by nearly 20% in April. Late March and April, 20% down in the markets. Big impact, right? So that sucks, right? Bonds did well. Bonds helped support the portfolio. You got half equity position. So the market's down 20. You're down roughly about 4.5, maybe percentage because of the balance in the portfolio. So you're definitely down. And then we added near the bottom of the market, we bought those other halves of all those positions and onboarded the portfolio. Now, of course, 4 months later, you're far ahead of the game. Now, if you sold that bottom, you missed out on all those gains. But the purpose of only buying half the positions right now, the things I want to own, is that I can wait for those big corrections to buy that other position and then dollar cost average into the portfolio and drive that advance going forward. And so there's never a right time. So let's just assume today that you've got 100% cash in your portfolio, and you're just saying, okay, I don't want to miss out anymore. I need to participate. It's no problem. October, November, December tend to be we are beginning the seasonally strong 6 months of the year. October, November, December, January, February, March, April are the strongest months of the year overall. Now, we just had a boomer summer, which happens from time to time, but typically we're moving to the seasonally strong period. Got big drivers, as I said earlier, going into the year. We've got earnings, sentiment. Professional investors are off sides. They've got to play catch up for end of the year rebalancing, and you got corporate buybacks coming in. The last quarter of the year, almost a quarter of all corporate buybacks for the year occur in the last month of the year. So in the last 2 months of the year. So it's a big corporate buyback push to get it on the books by the end of the year. So you've got some good tailwinds. Take your portfolio to make your watch list of stocks you want to buy and say, okay, I want to buy these stocks. And how you kind of do this is up to you, but divide your cash into 6 parts and buy 1/6 of your positions this month, buy 1/6 of your position November the 1st, 1/6 on December the 1st, and keep doing that process every month. You could do it in quarters, you could do it in thirds, depending on how fast you want to get into the markets. But you let the markets, as the markets advance, just keep buying. And if you get a dip in the market, if we get a 3 or 5% correction, buy some more and just work your way into the markets. Now, that sounds difficult, right? Because again, it's like, well, yeah, but if I get all invested and the market has a huge correction, then what? That's okay. The hardest part of managing a portfolio is actually getting invested. That's the hard part. Once you're invested, it becomes relatively easy because all I have to do is now is just manage risk. I take profits and big winners. Like for instance, we just rebalanced all of our portfolios this past week. So we took profits in our big winners. We added to positions that we wanted to own. We added meta to the portfolio on this pullback. So, we did some things like that. That's what corrective opportunities give you to do. And if you manage the risk, you can manage the drawdown risk. You can manage the risk to the downside. As I said with Adam a few minutes ago, if this market tops and we begin to see all the signs of a classic top, we'll be at 15% equities. We never go to zero. We're never 100% out of stocks for a whole variety of reasons. Like we can explain that some other day.
Because it's hard to get back in when you get to zero, as you're saying now.
That's the biggest thing. As a lot of people are finding out, being in cash is difficult. But so we'll get down to 15% equity. So if you think about that, if the market goes down 10% on like 15% equities, I'm down 1.5. Who cares, right? That's easy. So again, managing the portfolio risk is so much easier than trying to get in the markets. But just getting into the markets, you just have to start. And it doesn't matter where the markets are trading. waiting for that big correction, you're going to wind up giving up so much gain. Time you get there, the correction is not going to matter. You're so far behind the curve at that point, you can't catch up.
Okay. All right. Well, well said. And hopefully, folks watching, if you were one of those folks feeling squeezed by those emotions that I mentioned, hopefully that gives you some, guidance to aspire to. And obviously, the easiest thing to do if you are wrestling with this is just talk to a good financial advisor and get their counsel. And whether it's one you have or Lance or anyone else, but don't just sit there and stew. All right, Lance. We'll start wrapping it up in a minute. We'll get to your trades in just a second. Bonds. Anything you want to say about bonds?
They're doing great. I mean, a couple of weeks ago we got down to 4% ish almost, and I wrote a piece then saying, hey, we could see interest rates tick back up to around 4.2. They did that. Now they're starting to trail off again here a bit, but bond yields are putting in a much more bullish formation. And if we get a strong rally, if we get a dollar rally at some point, in particular, and bonds are performing better, that's going to help that dollar rally as well. So again, I'm still, yields are going to track inflation and economic growth. And so if we get 2% economic growth and 2%-ish inflation over the next year, we should have yields around 2.5. So, bonds still look pretty good here.
Okay. So I don't want to say you're calling for this, but you are kind of hoping that bonds will be down to 2.5 at some point next year?
Not in the next year. It'll take time to get there. So if it takes 2-3 years to get to 2% inflation, it's just assuming kind of a gradual disinflation. It'll take some time to get there. But yeah, I mean, you'll eventually see yields should trade somewhere between economic growth and inflation, somewhere around that level with a small premium. So again, 2.5% ish in a 2% environment wouldn't be surprising.
So let me ask you this. Let's assume for a second that tariffs don't have any inflationary effect from here on out. And I know that's your default anyways.
Right.
Not everybody thinks that way, but you do. But I'm just curious, just from the shelter component of CPI, I mean, where are we right now with CPI? 2.8, 2.9?
2.8, 2.9, yep.
If and as the lagging shelter data in the official CPI calculation starts to catch up with the real-time data that we're seeing, I mean, wouldn't you expect CPI to start coming down pretty materially next year?
It's going to come down dramatically. And this is, we just actually posted an article on Wednesday. Michael Leibowitz did a great piece on this exact thing. Excuse me, discussing Stephen Moran. Stephen Moran was the outlier on the Fed,
the FOMC,
yeah, the FOMC on the recent meeting. And if you look at the dot plot as an example, this is a dot plot of the last meeting. This dot down here is Stephen Moran.
Yeah, and I want to say we laughed about that and predicted it when we saw it before they actually admitted it was Moran. We were like, we know who that dot is.
We know who that dot is. But everybody was like, oh, he's just being political. He's not really being political. He's a very, very smart guy. And he's done a whole paper on why rates should be lower. And part of that comes into the new tenant rent index and CPI shelter. So CPI, 40% of CPI is homeowners equivalent rent and the rent index. That makes up 40%. So it doesn't really matter. This is the whole funny thing about tariffs is that tariffs are a one-time impact. So once I put a tariff on something, that's the inflation. It does. I don't keep adding a tariff every month, right? So once the tariff is there, it's imputed. So if the price of that good or service doesn't change over the next 12 months, there's no inflation, even with the tariff. So, and tariffs only impact really the good side of the economy. So goods make up about 30% of our economy. Services are 70%, which have no impact from tariffs. So, and the bigger part of that is that even with tariffs, they're so outweighed by the 40% of the CPI index is driven by rent that you can't have an impact. So what's important is that this orange line is CPI. And this blue line is the new tenant rent index. And the new tenant rent index leads CPI by a decent margin here. You can see this back in 2007, 2008, it led CPI pretty well. New tenant rent index led it in 2021. We sent stimulus checks to households. Everybody that rented an apartment said, yeah, we're raising rents because everybody's got a $1,500 check to rent an apartment. That's all now reversed and it's reversing sharply. So there's a lot of that 40% is going to drive inflation over the next, year to two until you start to see these rents start to stabilize. And, so that's going to be the important driver here.
Okay, so just to your question then, you said earlier you thought we might have 2% economic growth next year, or
Mhm.
2.5.
Yep.
We just made an argument there that CPI could be in the low twos to
Yep.
2.0 by the end of next year if shelter keeps coming down like this.
Right.
So given your math of, hey, they should all be in the same ballpark, why wouldn't bond yields get down to 2% at some point by the end of next year?
They could. I'm just not willing to stick a time frame on it because there's so many kind of moving parts in the economy right now, that it kind of makes timing when I can say, look, the target's pretty much there. It's just like the dollar trade, right? Everything's set up for a really strong dollar trade. I just can't time it. So, this is one of those trades that we start building very slowly over time. And we'll start building in a dollar trade at some point here and into the portfolio through whatever holdings we have, and we'll set that up because the odds of that happening are very, very strong. The odds of yields going lower are very, very strong. The timing becomes difficult. So I wouldn't make a big bet today because you could be stuck with some dead money here for 6 months or 9 months by the time we see the economic variables all come into play.
Okay. All right. Well, then how about trades? When we talked last week, you had started a lot of rebalancing. Sounds
Yeah.
like you continued it. And if I heard you right, sounds like you finally actually found your entry point for Meta.
Yep, we did. So yeah, so so last week before we talked, I had just rebalanced all the thematic models, and I had actually rebalanced the crypto model again this week because because one position in particular, but a couple of them ran so hard this week that that portfolio since August the 1st is now up over 20%, and I had to rebalance it twice within the last week or so because positions were actually doubling in size relative to their weight in the portfolio. So I had to keep rebalancing it back to target. So we did that this week, and then in the core models, which are dividend equity model, our ETF model, and our primary equity model, we rebalanced those this week. We did a few sales, nothing major. We did add Meta finally. We had sold Apple earlier this year just because they're really not growing revenue that much, and we were waiting for a better kind of an oversold opportunity to add Meta. And so we built a starter position in Meta this past week, and I'm hoping that I can get Meta to pull back some more so I can add the other half of that position.
Okay. All right. Well, we'll keep tracking it live here every week with you.
Yeah.
So if and when that happens, you'll let us know.
Yeah.
Um, okay. Well, look, I want to get a quick rant in here and then we'll wrap things up. So I was back in California briefly recently for the Gentlemen's Olympics, and I think we've talked about this in past years, Lance. But
Yes.
it's
I
the
think that's the
funnest day of
funniest
the
thing
year for
ever.
me. Yeah, it's the funnest day of the year for me. It's a group of guys here, and most of them I don't see for much of the year until this day. And we get together at the house of the fellow who's sort of this was his brainchild, and he organizes the whole thing. And it's probably about, I don't know, 2 dozen of us. And we kind of dress up in, Gatsby-like costumes, and we play a whole bunch of games together. So it's everything from axe throwing to billiards and darts and ping pong and bocce and shuffleboard and foosball and horseshoes and something crazy called Okie horseshoes. And it's just a great day with guys, and it's really well produced. Like he puts a lot of work in advance to build brackets, and you start the day early in the morning and you play your first waves, and then as the day goes on, you advance further and further until you get to the quarterfinals and the semifinals, and then at the end of the day, everybody goes and watches the finals of every sport. Super cool, super fun. Every station, every game station is sponsored with a drink. So about halfway through, the guys are getting pretty sloshed. I
Yeah.
don't drink. And I tell you, this past year was it was a tough year for me because I didn't do nearly as well as I would have liked. Standing, my games were all good, but I didn't win nearly as many as I'd hoped. And it's really irritating when the guys are getting drunker and drunker, and yet they're beating you by bigger and bigger margins as the sober guy. But
It
anyways,
was
it was a great time, and I got to because I've now moved to Nevada. Sort of some farewell. I mean, I'm going to see the guys again next year, but sort of like, hey, we know you're moving. We want to have some meaningful parting words with you. And while I was back too with them, I went and saw a mentor of mine, business mentor of mine. He's a guy I've talked about a couple of times over the past years. Maybe sometime I'll have him on this channel. He's a really successful entrepreneur, but he's also uh, just like a student of personal development. And anyways, long story short, I have relied on his counsel many times when I've been making a big business decision or big life decision. And we went and we had lunch, and it ended. We had a great lunch, and we really kind of said goodbye to each other. And then he turned around and he came back and he said, "Hey, I just want to tell you, like I'm really proud of you. I feel really good about where you are right now." And he said, "I remember where you were when you were struggling with the decision to leave your prior company and the risk that you were taking on and what you were going through. And it's so great to see where you are now and what's become of Thoughtful Money and all the momentum it has behind it." And it was nice to hear all that stuff, but it was particularly meaningful because besides him and you, Lance, I mean, there are very few people, I think, who really know kind of the full story of my journey there. There's a lot I haven't been able to say publicly. And I got to say, it's really nice to be understood. And that was sort of the gift that he gave me, is he said, "Hey, look, I've been following you. I've kept close to your journey and your story, and I want to reflect back to you the progress you've made." And that happens so rarely in life.
Mhm.
And with this gentleman's Olympics thing, I had one or two conversations with these guys where we're all men. Men aren't really great in expressing their emotions and whatnot. Like you and I, we spend most of our time tearing each other down. But a few of them really took the
That's what
time
guys
just
do.
yeah. But a few of them took the time to kind of drop the wall and just say, "Hey, I've really valued your friendship for reasons X, Y, or Z. I wish you really well for these reasons, but it's been a meaningful friendship to me for this reason." And it feels great. And I guess where I'm going on this rant is um, oftentimes in our relationships, there's a lot of stuff that's unspoken because we take it for granted. And I don't mean like we dismiss it, but we just assume, okay, yeah, this is what's understood, right? But every so often, it's just really nice to say the unspoken to somebody else and just put it on the table and kind of reaffirm. It's like watering the plant, right? It's just like, hey, maybe you don't even need it today, but I think this is going to feel good for you, right? And my wife's a therapist, as you all know, so this is kind of the world she lives in. And one of the things that she has her clients do a lot is something that's called active listening, which is, two people come to her, usually they're in conflict, right? And she says, "Look, I don't want one of you is going to talk, the other you is going to listen. And the one who's listening, your job is to not say anything, right? Just let the person kind of get out what's in their mind and what they feel. Your job is to, after they're done, repeat back to them as best as possible a summary of what you heard them say, right? You don't have to agree with it, but your job is to try to get it as right as possible from their point of view, right? And it's an incredibly useful exercise because the other person usually will say, "Wow, yeah, you got it. Like for the first time in a long time, like I feel heard by you." Not even necessarily asking you to change your mind yet. I just want you to know how I feel and be able to reflect that back to me, right? And I think that's part of the value I was getting out of these conversations is these guys were just taking the time to say the unspoken and make sure that I heard it, in a way that was authentic for them. So where I'm going with this is, Lance, I'm guessing, maybe you haven't, but I'm guessing you probably had some of these experiences of late with your wife and people in your life just saying, "Hey, I don't say it enough, but hey, I really value this part of you,
Right.
or have, love this part of it. Hey, this just makes me feel great when we're together doing X, Y, or Z, right? And my ask of folks watching today is just, pick somebody in your life today to do this with, just think about, hey, why do I enjoy this person? And when's the last time I really told them I did and why I did? And I guarantee you, it'll yield nothing but great dividends for zero cost on your end.
Yeah. Yeah, they say it, it costs nothing to be nice to somebody. It also costs nothing to be an asshole to somebody too. So,
Well, I think it
there
costs you
is
in the long
that.
run.
But no, to your point, and particularly with guys, right? Like when you were talking, I just wanted to interrupt and go, I'm sorry, I wasn't listening.
Yeah.
But,
You say something, Adam?
yeah,
Sorry.
yeah, I
Yeah.
don't know what you're talking about. But no, it's very true. It doesn't cost anything, and again, we talk about this a lot with relationships and with your spouse, and you will be surprised what results you can get from your spouse just by saying, hey, I appreciate you. Appreciate what you're doing. I value you being here. You look very pretty today. And again, we get into a lot of these relationship struggles where, again, it's just lack of communication generally more than anything else. And it took a long time for me to learn this. My wife and I used to butt heads a lot when we first got married
Hmm.
because we were still learning how to deal with
Right.
each other,
Well, and
right?
it was your second rodeo too, right? I mean,
Yeah, well,
you,
hers
yeah,
too. It was
yeah.
both of ours, and we both had previous marriages where our spouses were not good fits for a variety of reasons, and they were very anti our personalities. And my wife and I's personalities are very similar, which is also problematic because we have a lot of the very kind of our personality traits are very similar. So it works good in some instances, but it can also kind of work against you. But it took a few years to where I just learned that all she wanted was validation. All
Hmm.
she wanted, she works hard, she takes care of the house, she takes care of the kids, and she will bend over backwards for you to do anything you want as long as she feels like you validate her or that you at least appreciate it. And it took me a while because I'm a guy, right? We just don't go around saying, "Hey, good job, Adam. You look great today,
Right,
Adam."
right, right.
We're just guys. We don't do that. And it took me a long time to realize that was her love language. She just needed me to say, "Hey, I appreciate you doing that. Here's some flowers, just for no reason here." And it was just those type of things, and it made a world of difference in our relationship. And again, but this happens with every relationship, and particularly with guy on guy relationships. Again, it's I saw the other day there was this video of this girl saying guys are so complicated, and this guy pops up on the video and says, "No, we're not." He says, "We can see a guy we haven't seen in 15 years and go, sup, and we're good."
Yeah.
That's all it takes for us. We're very basic creatures. And for women, that's hard for them to understand in a lot of cases that we are very basic and we don't have a lot of needs. We don't have a need to express emotions and those type of things in a lot of cases. But that's where we've got to go that little extra distance. It means a lot. But even between guy and guy relationships like you and me, we're good friends, but I don't come on here every day and go, Adam, you look great today, bud.
Yeah.
Nice seeing you. Appreciate what
Yeah.
you're doing. We just don't do that. But when you do express that on a sincere manner, it means a lot.
It does. And I think we're pretty good about it in the sense that, yeah, it's not it's not every time we talk by any stretch. But I think when it matters, we're pretty
Yeah.
good about saying, hey, but yeah, and so I mean, I think in all parts of your life, your spouse, your kids, your friends, male, female, just this is the kind of thing that I think kind of the more you do, you probably can't overdo this, but but I think particularly guy on guy, and of course Lance and I are guys, so there's probably a female on female version of this that we don't fully appreciate. But I would encourage the guys watching this to look for another man in their life and say, hey, let me try this out. It might feel a little weird initially, but
I would suggest doing it with somebody you know.
yeah, there you go. That's a good copy. Yeah, don't do it with a total stranger. Um, but uh, but yeah, it's just one of those things like um, yeah, I don't know. Like, you know, once in a blue moon, my wife will come up and like, I mean, I'm talking like 2 years or so, give my shoulders an unprompted massage or whatever. And I'm like, you know what? I did not in the moment have a thought at all that I would need a massage. But you know what? Like that feels great. Like totally unexpected, right? Getting just some authenticity and hopefully authenticity in a way that matters and is bond developing. There's only good stuff that can come from that. And last thing I'll just say on this is, um, you know, I talk about how wealth being really three things. And again, this is all research based. It's quality relationships, it's purpose in your life, and then it's health. And for quality relationships, quality relationships are based on trust and goodwill. And that is not something you can create out of thin air. The only way you can create that is out of repeated interactions that build that, right? And
That's right.
so, because of that, invest. It's like investing in a bank account, right? It's just an emotional bank account. Every so often, just make sure, hey, have I deposited enough in there? And if I haven't, well, let me put a little extra in today.
Yeah, yeah, that's
Okay.
right.
All right, folks. Well, hopefully that's a good, inspiring thing to take away from this. If you think that one of the best ways to deposit into your own emotional bank account is to continue to watch Lance Roberts on this channel week in and week out, please let him know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. I want to thank everybody. We did end up crossing 150,000 subscribers on this channel, so that's a fantastic milestone. Again, that is all attributable to you who watch. Thank you so much for doing that and for all your support for this program. As I always say, and have already said in this conversation, if you'd like to get some help in positioning your finances for what may lie ahead, particularly if it takes one of the paths that Lance and I have talked about here on this program, highly recommend that most people get the help of a good professional financial advisor in doing so. And ideally one that takes into account all the macro issues that we talk about here on Thoughtful Money. If you've got a good one who's doing that for you, great, don't mess with success. But if not, consider talking to one of the financial advisors that Thoughtful Money endorses. Maybe even want to talk to Lance and his team there at RIA to do that. Just fill out the very short form at thoughtfulmoney.com. The advisors will be in touch with you immediately after that. And lastly, don't forget, we've got the conference coming up really soon. Again, you only have a couple days left to lock in the early bird price. So go do that now over at thoughtfulmoney.com/conference. And if you're a premium subscriber to the Substack, go use the code I've sent you to get an additional $50 off. Lance, as usual, my friend, I'll give you the last word here.
No, it's great. Well, again, this is Thursday, so we'll see what happens tomorrow. But again, we'll have the newsletter out this weekend on this whole AI thing. So it'll be posted over on Substack. I think Lance Roberts, and then Adam will post it, and then I'll also post it on our website, realinvestmentadvice.com. But I think it's a good read because we talk about how to actually navigate the bubble.
All right. Well, who doesn't want to know about that? Okay. Well, folks, go check that out when it's out and available. Lance, you have yourself a great week. And everybody else, thanks so much for watching.